There's a reason why the polished Instagram real estate gurus avoid this topic. It's because the real work of real estate investing, the stuff that protects your downside and keeps you out of lawsuits, tenant complaints, and financial ruin, isn't sexy or they don't know it, but you can't skip it. Because what happens before you buy the deal matters just as much, if not more, than what you do after. Let's talk about the real risks, the paperwork no one checks, and the due diligence you must do if you want to avoid being the sucker holding the bag. We're diving deep into what top investors know and what the salesmen conveniently leave out. You don't get rich by buying problems. Let's start with a harsh truth. You don't make money on the pro forma. You make money on the real rent roll. You might see shiny Excel spreadsheets promising 15% cash-on-cash returns. But if those numbers are based on projected rents and future improvements that you'll have to pay for, you're not buying a performing asset, you're buying risk. If those pro forma rents were so easy to hit, the seller would have raised them already. So your first rule? Never make offers based solely on pro forma rents. Demand the actual rent roll. Ask to see lease agreements, real ones, signed by tenants with expiration dates and monthly amounts. You're not buying potential. You're buying reality. Inspect everything because nobody else will. Too many investors skip inspections because they're in a bidding war or they're told it's as is. That's like buying a used car without checking under the hood. Get a full property inspection, and that means plumbing, roof, HVAC, electrical systems, foundation mold and water damage, termites or pest issues, and inspect it like you're going to live in it. Because if something breaks, you're paying for it. And while you're at it, get a sewer scope. Older properties might have root intrusion or collapsed lines. It's a 300-hour test that can save you $20,000 in underground surprises. Verify occupancy permits. Don't assume compliance. Here's where many new landlords get crushed. You assume that just because the property has tenants, it must be legal. Wrong. In many cities, you need an active certificate of occupancy to legally collect rent. If that certificate expired or was never issued, you're violating code, and a tenant attorney could sue to get back every dollar of rent they ever paid. Also check for zoning compliance, especially on converted units, ADUs, or basement apartments. Cities can and do red tag units if they weren't permitted properly. Dig into building violations. Don't trust what you can't see. You wouldn't believe how many buildings have open violations or stop work orders filed with the city. That HVAC the seller said was brand new might have been installed without a permit. Those updated windows might violate energy codes or egress rules. Go to the building department or access the online database and pull all the violations on the property. If you close without checking and inherit those violations, you're liable, not the previous owner. Title issues, easements, and strange legal ghosts. Not all risks are physical. Some are legal landmines. You need to make sure your title is clear. No mystery owners, no uncleared liens, no unpaid contractor bills that could become mechanics liens. Easements can allow your neighbor to legally access your property or block you from adding fences or additions. Hire a real estate attorney to review the title work, survey, and deed, and make sure they're working for you, not just the seller's lawyer reusing documents. Here's why your team might not protect you. Let's be blunt. Most real estate agents, property managers, and even some attorneys are transaction-focused. They get paid when you close. So unless they're true fiduciaries with your long-term wealth in mind, their incentives are not aligned with yours. A lawyer might not mention that open violation because it's technically not their job. A property manager might skip over a poor rent history because they want the management gig. An agent might talk up the upside without ever warning you of tenant headaches, plumbing age, or market turnover. That's why you need to know this checklist yourself, so no one can take shortcuts on your dime. Beware of overpaying for upside. You'll have to create too many deals today are priced for the dream, not the reality. If you're buying a property with below market rents, deferred maintenance, and room to add value, you better make sure you're not already paying the price as if the work is done. You should never pay full market price for a building you still need to renovate, re-tenant, or reposition. Here's the truth. If you're going to do the heavy lifting, the seller shouldn't be getting paid for it. This is where multiples on invested capital, MOIC, come into play. If you're investing $200K and the property gives you $600K in return after 5 years, That's a 3x MOIC. But if you overpaid and now the return is just 350K, your MOIC dropped to 1.75s. And all that effort looks a lot less exciting. Cap rates must be compared to interest rates. Always if you're passive, you can't ignore the relationship between cap rates and current interest rates. If you're buying at a 5% cap rate when your cost of capital is 7, you're bleeding from day one. Smart buyers know that cap rates are risk pricing. If there's no growth upside, rent control, or a tough market, you need a much higher cap rate to justify the risk. Here's a guideline. Rent-controlled markets. You want a cap rate of 7% tuition minimum. You're unlikely to grow rents, so your return must come up front. Markets with true value add. If you're confident you can raise rents, improve NOI, and exit at a better valuation, you can accept a lower cap rate, maybe 6%, but only if the value add is real. Stabilized assets. In strong appreciating markets, a 5-6% cap can work if debt is cheap and rents are rising. But that's no longer the case in 2025. Compare cap rates to 10-year Treasury yields. If there's no spread or a negative one, you're likely overpaying. Don't let sellers' brokers sell you fake upside. Pro forma is fantasy. If rents were really 400 under market and easy to raise, they'd already be raised. Ask yourself, what lease terms are in place? Are these tenants month to month or on long-term leases? Is the market actually paying those higher rents? Or is it just the top 10% of units? Are the units upgraded? Or will I need to drop 25K per door to justify the rent bump? Never pay for upside you haven't secured yourself. Buy based on today's numbers. Vet your property manager like your wealth depends on it. Because it does. The fastest way to lose your investment? A bad property manager. Before you hand over the keys, interview your property manager thoroughly. In fact, watch our video. 25 questions to ask your property manager. It's a full playbook on how to separate amateurs from pros. Ask, how do they screen tenants? How often do they inspect units? How do they handle repairs and maintenance? What's their eviction process? The right manager protects your NOI and your peace of mind. The wrong one? They'll destroy both. Final thoughts. Real estate is wealth, but only when you buy right. Here's the truth. The real money in real estate is made when you buy, not when you sell. Your job as an investor is to eliminate surprises, protect your downside, and make sure you're buying an asset, not inheriting a liability. Most gurus won't tell you this because it slows down their funnel. But if you want to build true wealth, the boring stuff, the diligence, the legal, the inspections, that's what keeps you in the game long enough to win. So ask the hard questions. Run the ugly numbers. Say no to bad deals, even when they're dressed up pretty. And always remember, in real estate, what you don't know can hurt you. Let's go make smarter moves. Subscribe for more no-fluff real estate strategy, deal checklists, and risk management playbooks. Drop a comment. What's the biggest red flag you've seen on a deal that no one else has noticed? Link in the description for the property manager vetting guide and more tools to make better investments.